Preparing for a Dominion Energy FP&A Analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A mean to you, and how would it support Dominion Energy? FP&A connects operating performance, capital needs, and liquidity to management decisions. At Dominion Energy, I would understand regulated utility economics, including rate-base investment, allowed returns, customer demand, fuel costs, and reliability obligations. I would build a transparent forecast, compare actual results with plan, explain the drivers, and translate findings into actions. The role is not simply reporting numbers, it is helping leaders allocate capital and manage risk. Strong FP&A should make the business easier to understand and operate. While answering, focus on planning, forecasting, variance analysis, decision support, utility economics, capital intensity, and communication with operational leaders. Explain how FP&A turns financial and operational data into an actionable outlook. Question 2. Why do you want to work in FP&A at Dominion Energy? I am attracted to Dominion Energy because FP&A here sits close to decisions involving essential infrastructure, reliability, customer affordability, and long-term investment. The regulated utility model also requires disciplined analysis because returns, capital spending, and rates are closely connected. I enjoy understanding operational drivers rather than analyzing financial statements in isolation. This role would let me apply forecasting and communication skills while learning how finance supports grid modernization, renewable investment, cost management, and dependable service over many years. Make sure to cover your interest in combining finance with operations, Dominion Energy's regulated utility model, infrastructure investment, reliability, energy transition, and the opportunity to support long-term decisions with disciplined analysis. Question 3. Walk me through your approach to building an annual budget. I begin with a clear calendar, prior year actuals, current year run rate, and guidance from leadership. Then I meet operating owners to identify business drivers such as headcount, maintenance activity, customer growth, fuel prices, and project timing. I build assumptions transparently, link the operating plan to capital and cash requirements, and challenge unsupported changes. After reviewing scenarios with stakeholders, I consolidate the budget, document approvals, and establish monthly metrics so performance can be monitored against the plan. In your answer, talk about historical actuals, business driver assumptions, ownership by operating teams, capital and expense coordination, review cycles, documentation, scenario testing, and final approval and monitoring. Question 4. How would you forecast revenue for a regulated electric utility? I would separate revenue into customer volume, usage, approved rates, and other mechanisms such as riders or recovery clauses. I would analyze historical seasonality, customer growth, weather sensitivity, load patterns, and expected regulatory changes. For example, unusually mild weather could reduce usage without indicating a structural decline. I would align assumptions with commercial, regulatory, and operations teams, then run base, upside, and downside cases. The forecast should explain both the mathematical build and the business judgment behind it. Be sure to mention customer count, usage or load, weather, rate changes, regulatory treatment, rider mechanisms, seasonality, historical trends, and collaboration with commercial and operations teams. Question 5. How would you analyze a monthly unfavorable operating expense variance? I would first validate the accounting and compare actuals with both budget and prior year. Then I would decompose the variance into price, volume, timing, mix, accruals, and one-time items. For instance, a maintenance overspend may reflect accelerated work rather than poor control. I would discuss the result with the responsible manager, review invoices or operational metrics, determine whether the forecast needs updating, and present a concise explanation with recommended actions and any remaining uncertainty. Focus on separating timing, volume, price, mix, and true run rate changes. Mention materiality, recurring versus one-time items, owner discussions, supporting evidence, forecast implications, and management actions. Question 6. What is the difference between a budget, forecast, and long-range plan? A budget is an approved operating commitment for a defined period and usually becomes the baseline for performance measurement. A forecast is an updated expectation of where results will land, using current information and assumptions. A long-range plan extends several years and focuses more on strategy, capital needs, financing, regulatory developments, and major risks. I would use the budget to measure execution, the forecast to manage the current outlook, and the long-range plan to guide investment decisions. Explain the purpose, time horizon, refresh frequency, level of detail, and decision use for each. Highlight that the budget is a performance baseline, while forecasts and long-range plans support adaptability and strategy. Question 7. How would you forecast capital expenditures for Dominion Energy? I would build the forecast project by project, starting with approved scope, committed contracts, construction milestones, expected in-service dates, and updated engineering estimates. I would distinguish committed spending from discretionary or timing-sensitive work and include contingencies for major risks. I would reconcile the project view to the corporate capital plan and cash forecast, then review changes with project managers. In a utility, timing matters because capital spending affects rate base, financing needs, depreciation, and future earnings. Mention project schedules, engineering estimates, construction timing, regulatory approvals, committed versus discretionary spend, contingencies, cash flow, and coordination with asset owners and project management. Question 8. What utility-specific KPIs would you monitor in FP&A? I would monitor both financial and operating indicators. Financial measures could include revenue, O&M per customer, capital spending versus plan, operating cash flow, liquidity, and earnings drivers. Operating measures might include customer growth, load, outage frequency and duration, safety performance, project milestones, and generation or fuel metrics where relevant. The key is connecting them. An outage trend, for example, may increase costs, affect customer satisfaction, and influence required reliability investment. KPIs should support decisions, not create reporting volume. In your answer, include customer growth, load, revenue, O&M, capital spending, outages, safety, reliability, cash flow, liquidity, and regulatory or operational measures linked to financial performance. Question 9. How would weather affect a utility forecast, and how would you model it? Weather can materially influence electricity or gas usage, especially through heating and cooling demand. I would quantify historical relationships between degree days, customer classes, and revenue or usage, then compare current weather with normal conditions. I would incorporate a normalized view into the forecast while preserving actual expected conditions for near-term reporting. I would also run sensitivity cases because weather-driven changes may reverse. The analysis should distinguish temporary volume effects from longer-term shifts in customer behavior or efficiency. Cover heating and cooling degree days, historical normalization, customer mix, seasonality, weather sensitivity, scenario analysis, and the distinction between temporary variance and structural demand changes. Question 10. How would you evaluate a proposed cost-saving initiative? I would establish a validated baseline and define exactly how savings will be measured. Then I would estimate implementation costs, timing, recurring versus one-time benefits, staffing effects, and operational risks. If a process redesign costs $2 million and saves $800,000 annually, I would calculate the payback and assess execution confidence rather than presenting the savings alone. I would assign ownership, build the initiative into the forecast, and track realized benefits against the approved case through monthly reporting. Make sure to cover baseline costs, implementation investment, timing, measurable benefits, one-time versus recurring savings, operational risks, ownership, sensitivity analysis, and whether savings affect cash, earnings, or both. Question 11. What is a driver-based forecast, and why is it useful in utilities? A driver-based forecast links financial outcomes to measurable operating assumptions instead of relying only on historical percentages. For a utility, revenue may depend on customers, usage, weather, and approved rates, while labor expense may depend on headcount, compensation, and overtime. This approach makes assumptions easier to challenge and update. If customer growth or fuel prices change, the model can refresh quickly. It also improves communication because managers can see which operational actions are driving financial results. Explain operational drivers, transparent relationships, scalability, sensitivity testing, and examples such as customers, usage, headcount, maintenance activity, fuel prices, and project milestones. Question 12. How would you explain a financial variance to a non-finance executive? I would lead with the conclusion, quantify the impact, and explain the 2 or 3 largest drivers in plain language. For example, I might say operating expense is $4 million unfavorable, primarily because storm restoration occurred earlier than planned, with $1 million expected to reverse next quarter. I would distinguish confirmed facts from estimates, explain the forecast implication, and recommend an action. Executives generally need clarity on cause, persistence, risk, and response rather than a detailed spreadsheet walkthrough. Focus on leading with the conclusion, quantifying the impact, using plain language, separating facts from assumptions, explaining business drivers, and ending with actions, risks, and forecast implications. Question 13. Describe a time you improved a financial reporting or forecasting process. In a prior role, monthly variance reporting relied on manually combining several spreadsheets, creating delays and inconsistent definitions. I mapped the process, standardized account and department mappings, and built a controlled template with automated checks. I also created a brief variance commentary guide for business owners. Reporting time fell from 3 days to 1, and review questions became more focused. I measured success through cycle time and error reduction, then documented ownership so the improvement did not depend solely on me. Use a concise star structure. Cover the original problem, root cause, specific improvement, controls added, measurable result, stakeholder adoption, and how you ensured the process remained sustainable. Question 14. How would you build a scenario analysis for an energy company? I would begin with a base case reflecting the best supported assumptions, then identify variables with the greatest uncertainty, such as demand, weather, fuel prices, project timing, interest rates, or regulatory outcomes. I would build upside and downside cases by changing those drivers consistently across revenue, expenses, capital, cash flow, and financing needs. I would show the financial range, key assumptions, and management actions available under each case. A useful scenario analysis clarifies decisions and triggers, not just possible outcomes. Mention base, upside, and downside cases, key sensitivities, probability or judgment, revenue, expenses, capital, cash, and financing effects, decision thresholds, and clear presentation of assumptions. Question 15. How do capital expenditures affect a utility's financial statements? A qualifying capital project initially creates a cash outflow and is recorded in property, plant, and equipment or construction work in progress rather than immediately expensed. As the asset enters service, depreciation begins and the balance is reduced over its useful life. Financing may create debt and interest expense, while regulated treatment can allow recovery through rates and an earned return on eligible investment. Therefore, capital spending affects cash immediately but influences earnings, rate base, and customer rates over time. Cover initial cash outflow, capitalization criteria, property plant and equipment, depreciation, construction work in progress, debt financing, interest, rate base, and eventual earnings and cash flow effects. Question 16. How would you assess whether a project is on track financially? I would compare actual and committed costs with the approved budget and calculate the estimate at completion. I would also review percent complete, schedule milestones, change orders, contingency usage, procurement status, and unresolved risks. A project can appear within budget while still facing a major schedule delay or unpriced contract change. I would meet the project manager regularly, document the drivers of movement, update the cash forecast, and escalate risks when projected cost or timing exceeds agreed thresholds. Be sure to mention approved budget, commitments, actual spend, estimate at completion, schedule, contingency usage, change orders, % complete, risks, and escalation thresholds. Question 17. What would you do if an operating leader challenged your forecast assumptions? I would first understand which assumption the leader disagrees with and why. Then I would review the supporting data, compare historical performance, and test the leader's alternative in the model. If the alternative is better supported, I would update the forecast and document the rationale. If uncertainty remains, I would present both cases with the financial impact and decision implications. My goal is not to defend a spreadsheet, it is to produce the most credible outlook through constructive challenge. Focus on listening first, tracing assumptions to evidence, testing alternatives, distinguishing judgment from fact, collaborating on ownership, documenting changes, and escalating only when material disagreement remains. Question 18. How do you ensure accuracy and integrity in an FP&A model? I use a structured model with clearly separated inputs, calculations, outputs, and assumptions. I reconcile opening balances and key totals to source systems, include checks for broken links and unexpected movements, and protect formulas where appropriate. I maintain version control and document changes, owners, and dates. Before distribution, I review unusual results against operational evidence and perform a reasonableness check. A second reviewer is valuable for material outputs because accuracy includes both formula integrity and business logic. Mention controlled inputs, reconciliations, formulas, checks, version control, documented assumptions, independent review, audit trails, and testing unusual outputs before distributing results. Question 19. What Excel tools and techniques would you use in this role? I would use SumIfs, XLOOKUP, pivot tables, and structured tables for recurring analysis, with Power Query when source data requires repeatable transformation. For forecasting, I would separate assumptions from calculations and use scenario controls to compare cases. I also build reconciliation checks, exception flags, and concise charts that highlight drivers. I am comfortable learning new systems, but I prioritize auditability and usability. The best spreadsheet is one another analyst can understand, update, and challenge confidently. Discuss pivot tables, XLOOKUP or index match, SumIfs, Power Query, scenario controls, data validation, charts, error checks, and practical model organization rather than listing functions without application. Question 20. How would you use actual results to update a rolling forecast? After loading actual results, I would analyze whether variances reflect timing, one-time events, or a changed run rate. I would update only the remaining periods, incorporating known events such as outages, project milestones, rate changes, staffing actions, or contract renewals. I would obtain owner input, test the revised assumptions, and reconcile the full-year result to the prior forecast. I would also explain why the forecast moved, so management can distinguish improved visibility from genuine performance change. Cover closing actuals, variance diagnosis, remaining period assumptions, run rate versus known events, business owner input, calendar updates, scenario changes, and preserving an explanation of forecast movement. Question 21. How would you analyze the impact of interest rates on Dominion Energy's plan? I would map the debt maturity schedule, expected refinancing, new borrowing tied to capital spending, and fixed versus floating exposure. Then I would apply rate sensitivities to interest expense, cash flow, earnings, and liquidity, distinguishing locked-in costs from assumptions that can change. I would also consider credit metrics and financing flexibility. For example, a 100 basis point increase on a refinancing tranche could materially affect annual interest. The analysis should inform funding timing and communicate downside risk clearly. Mention debt refinancing, new borrowing, interest expense, cash flow, capital funding, rate sensitivity, liquidity, credit considerations, and separation of locked-in versus floating exposure. Question 22. What is the relationship between cash flow and earnings in FP&A? Earnings and cash flow are related but not interchangeable. Depreciation reduces earnings without using current cash, while capital expenditures reduce cash before depreciation affects earnings. Working capital movements, storm costs, fuel payments, debt issuance, and regulatory recovery timing can create further differences. I would forecast the income statement and cash flow separately, then reconcile them through operating, investing, and financing activities. Management needs earnings visibility for performance and liquidity visibility to fund operations, obligations, and capital investment. Explain accrual versus cash accounting, non-cash depreciation, working capital, capital expenditures, financing, regulatory timing, and why both earnings and liquidity must be forecast separately. Question 23. Tell me about a time you had to meet a tight deadline with incomplete data. During a forecast cycle, one business unit had not submitted final project estimates, but leadership needed an outlook that afternoon. I used the latest approved schedule, actual spend trends, and comparable project assumptions to create a preliminary estimate. I clearly labeled estimates, quantified the range of uncertainty, and contacted the project manager for critical updates. I delivered on time with a sensitivity analysis, then replaced assumptions when data arrived. That approach balanced speed, transparency, and analytical discipline. Use STAR format and emphasize prioritization, materiality, transparent assumptions, stakeholder outreach, quality checks, delivery timing, and how you followed up to replace estimates with confirmed information. Question 24. How would you prioritize competing requests from senior stakeholders? I would assess each request by decision deadline, financial materiality, business risk, executive visibility, and dependencies. I would clarify the minimum useful output, estimate the effort, and communicate trade-offs early rather than silently missing a commitment. For example, I might deliver a high-level scenario for an immediate decision and schedule detailed segmentation afterward. I would maintain accuracy on critical numbers, confirm the priority with my manager when conflicts remain, and keep stakeholders informed about timing. Cover urgency, decision impact, materiality, deadline, dependencies, effort, communication, and negotiating scope. Explain how you would confirm priorities rather than silently allowing conflicting work to compromise quality. Question 25. What questions would you ask during your first 90 days as a Dominion Energy FP&A Analyst? In my first 90 days, I would learn the planning calendar, reporting hierarchy, systems, key definitions, and major revenue, O&M, capital, and cash drivers. I would meet finance partners and operating owners to understand their decisions, pain points, and expectations for useful analysis. I would review prior forecasts, variance commentary, controls, and regulatory context. After building credibility through accurate recurring work, I would identify one practical improvement, such as streamlining a report or strengthening a driver-based forecast. Mention understanding team responsibilities, planning calendar, key reports, systems, business drivers, stakeholder expectations, controls, regulatory context, recurring pain points, and opportunities to improve insight or efficiency. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.